Welcome to all of you. This is Anil Asnani, owner of Smart VRC, and today's our topic is Market My Beat. As I can feel from the feedback I keep on receiving from my esteemed subscribers, and also as I can see from the market, uh, investors in general are very much worried, especially those who have joined post-COVID. So we are going to address lots of challenges the investors are facing. And post this presentation, which will last for about 40 minutes, there will be a question and answer session. So whatever views being presented here are of my own uh, that may or may not hold. But let me tell you that I have been into this market since 1988 and I have seen 5 to 6 major crashes. And what I have learned from these crashes, I'm going to share with you. This is a standard warning. Investment in securities market are subject to market risks. Read all the related documents carefully before investing. This is the disclosure disclaimer. It is mandatory from SEBI. What is the objective? What is the objective of this webinar? What is the objective of the stocks we recommend? There are many things we do, and the simple objective is to help investors enhance their returns by offering valuable stock investment insights and recommendations. First things first, as you know, there is a change in US president, and there are a lot many things in the headlines like birthright citizenship, the automatic American citizenship that is granted to anyone born in the country is to be withdrawn. And in response, a federal judge in Seattle has said that it is blatantly unconstitutional. And then again, the response from the president that obviously we will appeal it. So these are the things which have already started. Uh, they are also going to take action against illegal immigrants, and the US may withdraw from the Paris Climate Agreement. US may withdraw from the World Health Organization. With oil prices going down, I will demand that interest rates drop immediately, and likewise, they should be dropping all over the world. So these are the few of the headlines which are making a uh, news not only at from the just the news, but also from the stock market point of view. And lot many things he has already said before coming to the power, like increasing tariffs and all those things. And he wants to make America a super strong power economically. Nothing wrong in it. Every country does that. But US being the supreme power, anything what the US does has a repercussion down the line. And that is the reason why the markets are jittery. Coming to the webinar contents, first we will have a look at the past market insights, then sector-wise prospects, then proven strategy to win, and then followed by question and answer session. The first is market insights. Let me ask you, during the last 35 years, that means from 1990 to till date, how many times BSC Sensex has fallen more than 10% in a year? You can write in the chat box. I think the question is clear. During the last 35 years, how many times BSE sensitive index fell more than 10% in a year? You can write in the chat box. So there are majorly two types of answers, either 30 or don't know. Of course, there are some with B and some with C, but so, okay, thank you. Thank you for the response. Let me tell you, there were exactly 21 times when the Sensex fell by more than 10% in a year. So in a gap of 35 years, 21 instances are there where the index fell by more than 10%. That means average in 1 year and 8 months or 9 months, Sensex falls by 10% or more. So post-COVID, this is the second time when the Sensex has fallen more than 10%, and there is nothing unusual about it. On an average, yes, this is the pattern. So, and market is like that only. That is the name of the stock market. So nothing to be feared as far as the present fall is concerned. Now, these are the basically various falls, various declines in Sensex. Like as I said, for more than 10%, it was 21 times the Sensex fell more than 10% during last 35 years. More than 15%, 16 times, more than 20%, 14 times, more than 25%, 7 times, and more than 30%, 6 times. So even more than 30%, Sensex has fallen by 6 times. That means average every 6 years, Sensex falls by more than 30%. And now the index has fallen by only more than 10%. Just about 12% to be very precise, it is 12.29%. As on date, Sensex has fallen from the peak of about 86,000. So if you look at this data, there is nothing unusual. Whatever has happened is a part of the Sensex, part of the market. These are the historic major falls. I started in 1988, as I said, and within 4 years, I saw a 52% market crashing in 91-92 scam. Then in the year 2000, there was a 56% decline. That is the dot-com bubble. Then comes the 2008, there is the Lehman crisis, known by the Lehman crisis, where the Sensex fell by 63%. And you won't believe, here, my portfolio fell by 86%. Can you imagine just the 86% fall in portfolio? Then comes the 2020, that is COVID, and most of you are aware, market fell by about 40%, and it took only 3 months. So this is how the Sensex has moved. We all know this. There is nothing great in this chart. The only thing is, it is plotted on a normal graph. It is not a logarithmic graph. So whatever the change, what you are seeing here, in terms of percentage, it is very different what you are seeing here. Okay. So these are the index performance, various index performance for the last 12 months. These all are BSE indices. Right? For the last 12 months, BSE consumer discrete goods increased by 13%, BSE auto by 18%, bank X by 1%, BSE FMCG fell by 1%. Normally, people say that invest in FMCG stocks, these are the safe one. Now, if you look at this chart, it is only the BSE FMCG index which has fallen by, though only by 1%, but it is the only index which has fallen. Whatever indices we have covered almost all the major, very theme-specific or sector-specific indices here. And the best performer is healthcare with 33% rise, and rest are PSU, realty, BSE telecom 23%, and average gains are about 12%. So these are very specific, very sector specific. So these are naturally very risky. And that is the reason why you can see a high of performance of 33% positive and a negative 1%, though the average is only 12%. Here, SBP has performed with a plus of 20%. Yes, during last 12 months, SBP stands for Smart Billionaire Picks, has gained 20%. That is way better than the average of 12% here. More about SBP in the forthcoming. Now, this is the comparison with regard to the large cap, mid cap, and small cap indices during the last 12 months, that is last 1 year. And during last 1 year, BSE Sensex is up by 4.85%. Small cap is still up by 7.7%, mid cap 8.5%, and large cap 4.9%. Of course, from an average compound growth of 15% in index. The last 12 months performance is way below at 4.85%. And let's see what the SBP did. As I said in the previous slide, SBP performed plus 20%. So SBP has performed 4 times better than the BSE sensitive index and even more than 2 times better than the best performing BSE mid cap index among these indices. So what is this SBP? SBP is basically a model portfolio which was started on 30th of May 2001, and presently it is available as a complementary for the subscribers of Smart Gains. The period is perpetual. Yes, we do the rebalancing only on Wednesdays. There is the frequency is Wednesday. Philosophy is intrinsic worth and approach is bottoms up. And the valuation technique we use is P to growth. All cap stocks are covered here. All recommendations during market pulse, and we do provide research report with every stock recommendation in this model portfolio. And once you subscribe, you get access to all the past stocks since inception. Since inception means since 2001. Now we are making this, soon we are going to make this a separate product, and subscription price will be for 3 months, and modalities are under preparation, and as and when we finalize, we will inform to all of you. We are taking a small pause in a sense. We would like to tell you what our firm does. Our philosophy is SMART. S stands for the story. As I said, it's a bottoms up. M for market. Market is your friend. Yes, market is always your friend. Either it gives you an opportunity to buy low, or it gives you an opportunity to sell high. When I say high and low, I mean valuations. Yes. And that is the crux of the making wealth from stocks. Assessment, we use the PEG ratio. And rational, yes, this is the one of the major factors which decides your return. You have to be very rational. You need not have to be emotional. Logically, what should we do? That is the rationality. Time is, of course, very important, and this is available to all of us for compounding. So this was all about the SMART. Coming to the products, we have one is Smart Gains, the other one is Smart Multibagger. Smart Gains started in 1999. Frequency is every Wednesday. Holding period 3 to 24 months. Yes, we do provide exit calls also. And philosophy is bottoms up. Valuation technique is P to growth ratio. This is universal to all our products and services. And all cap stocks are included. Recommendation time during market hours. Yes, we do provide research report, and subscription price for 3 months is 2,500 plus GST. There is another product with the name of Smart Multibagger. This was started 8 years after Smart Gains in 2007. We provide one stock every month. Holding period is pretty long, 2 to 5 years. Rest of the things are almost same, and subscription price is 2,900 plus GST. Now, many of you might have been might have been surprised to see that the subscription price, why it has come down to 3 months. So this is in line with the SEBI guidelines. Recently, SEBI has given a guideline that no research analyst can provide a subscription period of more than 3 months. So we are always here to assist you, not only in terms of the stock recommendations, but also in sharing knowledge and wisdom. We have many resources on website, mobile app, and soon, very soon, we are going to have many more new features on mobile app. Also the webinars like this, and seminars, workshops, publication, blogs, podcasts, television, and social media. So if you want to have a look at our past webinars, you can always go to our knowledge center menu, and then there on the webinar, then you can select the kind of webinar you want to watch. Yes, I'm the author of book Way to Billionaire, which is available in English as well as Gujarati. Also, we have financial freedom calculators on our website. That these calculators can be very, very useful to anybody who is planning for the future, maybe for any major event or even for the retirement. For all these things, you have to visit smartvrc.com. That is our website. What are the key differentiators? Myself, A.K. Asnani, I am a qualified research analyst with the qualifications like B, ERA, MBA, PhD, RA, and CPM. CPM is for Certified Portfolio Manager. This is from ICFI Hyderabad, and I'm the author of the book, as I said. Yes, it is the stock market only which made me to quit a high-paying government job, and after achieving, of course, after achieving the financial freedom, and now I'm pursuing my interest of equity research. The key thing here is to find the worth of the stock. Ultimately, it boils down to find the worth of the stock. For everything, there is a worth. If I have a cup, then it has its own worth, right? There is some worth associated with it. Maybe 50 rupees or 100 rupees, we know very well. But of course, it is not going to be 1,000 rupees for this cup. Similarly, for stocks, I'm very sure very few retail investors would like to know what is the worth of the stock. If someone says that this stock is good and buy for 7,000 rupees, no one asks what is the worth of that stock. Everybody is interested, badega. So that should not be the mentality. So that was all about the smart VRC. Now we come to the sector-wise prospects. This is the steel prices for the last 1 year. As you can see, the steel prices are going down, and of course, from last 5-6 months, they are more or less stable. Iron ore prices are more or less in line with the steel prices, and it has to be because iron ore is the basic raw material for the steel companies. This is about the copper. Copper has fallen from a high of 5 USD per ounce to presently about 4.2. That is about 18% down. This is about the aluminum, more or less at high levels. So nothing from the metals, we cannot conclude very strongly. But we can say that, yes, the prices are on a softer side. This is soda ash prices. These have come down significantly. So we should be very cautious while investing in the companies which produce soda ash. So these are the prospects. Prospects have been decided by me only. So for auto and related, these are just a kind of a neutral kind of prospects. Agrochemicals decent because agro prices were pretty depressed from last 1.5 year. Now the companies who have come out with the results during the last quarter and also during this quarter, some of the companies have already declared the results and they have declared decent gains. Banks, medium, because low NPS, of course, due to the microfinance companies, banks are also suffering, as you might have seen from the last couple of quarters. But I hope in the coming 1 or 2 quarters, this problem will be sorted out. Cables, these are decent prospects, as we have seen. Aluminum, copper, steel prices are soft. Cement, chemicals, chemical companies are reporting good results after a long time. And then defense, of course, because of the government. Hotels is good as the leader, the Indian hotels is very optimistic. IT, I have written cautious because of we do not know the US, what is going to be the US policy. And then is the packaging. Packaging companies have reported good results, especially BEPP companies. So many of you might have joined this webinar for the first time. So let me tell you, if you want to get the messages, insights with lots of insights and also about the forthcoming webinars and seminars, then I request you to save our WhatsApp number 9755920780 and also send your name and city at this number. And then we'll take care. And also don't forget to save our number. That is very important because we send the messages through broadcast route and those messages are delivered only if the receiver has saved our number. Proven strategy to win. So time and again, I have seen many of these kind of falls, these kinds of declines, and over a period of time, what I have found that I will share here. In the present context, I would I would suggest if you have high exposure to US export-oriented companies, then please uh, ensure that it is not more than about 15%. Of course, it is not that easy for the US to implement high tariffs because there will be retaliatory actions from the other countries also. But nevertheless, to be on a little bit on safer side, don't have high exposure to export-oriented companies which export their products and services to US. Focus on companies catering to the domestic demand because domestic demand is still there in terms of infrastructure, space, defense, construction. Companies with raw material dependent on crude oil can expect predictable and steady profit growth because US has already said that they will increase the production of their oil and gas, and this is definitely going to have a impact on crude oil prices to remain low and stable. Also, the US president has asked the oil producing companies keep the oil prices low and steady. Of course, that is dependent on the oil producing countries only. But if US has large reserves of oil and gas, if it decides to increase the production, definitely there will be a impact on the crude oil. Stay focused on the story. This is the crux. What is why you have invested in that company? What that company does? What are the future prospects? What is the order book and all those things? Now, the ultimate thing: remain fully invested. I am reading it slowly, and I will repeat many things. Remain fully invested means don't sell just because the market is falling, just because you think that the market will fall much more from here, because market is not predictable. So what I have learned during this my investment career of 35, 36 years is that one should remain fully invested. Don't ever try to predict the market. Okay. In top 20 exciting stories, in top 20, because statistically it is proved that 17 to 18 stocks are sufficient to mitigate the stock specific risk. Market risk, you cannot reduce, you cannot remove, but stock specific risk, yes, you can mitigate. At attractive valuations, just exciting story does not serve the purpose. It has to be at attractive valuations and it should be duly diversified. Diversified in terms of sectors, in terms of the business groups, in terms of the market capitalization, everything in terms of the market it serves. Like as I said, don't have too many stocks, too many exposure to US markets. So that is the ultimate thing. Remain fully invested all the time in top 20 exciting stories at attractive valuations, duly diversified. So your focus should be on the future. At what price you have purchased does not have any meaning. Yes, it doesn't have any meaning. What matters is what is going to happen in future. Ultimately, in the long term, share price follows the earnings. So this is what I say. Fundamentals is all about the past, and the future is what the growth. And that is how we use P to growth ratio. That combines two parts. P is the past, means the present price and the past earnings per share. And growth is the future. So comparing the past with the future. Oh, yes. Comparing the future with the past. If that is in your favor, then go for it. That is I call the story. Fear. So one of the full forms is false evidence appearing real. Yes, how? Now BSE sensitive index. was 42,000 at about 42,000 levels in February 2020. That is pre-COVID, right? Today, after 5 years, it is 75,000, roughly about 75,000. So that gives a CAGR of 12%, which is less than the long-term CAGR of 15% in BSE sensitive index since start. I hope you all are able to get my point. During last 5 years, Sensex has gained at the rate of 12% from pre-COVID levels, assuming that there was no COVID. So Sensex has gained at 12%, which is way less than the 15 to 16% compound returns Sensex has delivered since its start. Despite being down by about 13% from its historic high, the BSE Sensex is up by about 175% from COVID lows. Despite being down by about 13%, yes, the index was very near to 86,000 just a couple of months back. And from there on, the current levels are about 13% down. But still at these current levels, it is about 175% up from COVID lows. COVID lows means index was something 26,000. So there is a fantastic, even from COVID lows, it is a fantastic return. If you lost maybe about 15% or 20% in your portfolio, still the Sensex is up by 175%. Just imagine what kind of those who are into mid caps and small caps, and in good mid cap and small caps, those people can just imagine the kind of returns you have already got on those levels. And from where the market will go from current levels, that is just not possible to predict. And in this matter, I would like to tell you, I don't remember anybody who predicted the present kind of situation just 2 or 3 months back, just 6 months back or 1 year back. No one predicted. Similarly, no one can predict what's going to happen in future. The probability of success is as good as flipping a coin. Yes, but nevertheless, stock returns will continue to outperform other asset classes over a long term. If you are not able to cope with this fall, especially those who joined after COVID, if you feel that if you are ill, if you are emotionally very weak and you are not able to withstand this fall, then this is not your game. Let me be very clear. This is not your game. You can exit and look for the other assets, because this market is to create wealth, but not at the expense of losing the health. India versus the rest for the last 5 years, how India has performed, how the stock index has performed with respect to the indices of other countries. So BSE sensitive index during last 5 years is up by 89%. Nikkei, that is Japan, is up by 70%. Dow Jones, that is the US, is up by 57%. SSE Composite, that is the China, is up by 13%. And FTSE, that is the London Stock Exchange, and is up by 18%. And as you can see, last 5 years, India has been a dominant index performer as far as the last 5 years are concerned. Of course, for the last, as you can see, for the last 4-5 months, this BSE Sensex has underperformed compared to the other. But overall, for the long term of 5 years, it is way, way ahead. Now, this was for 5 years. What about this? How you will describe this situation? This from since start, since inception. BSE Sensex 13,300% up. Japan 235%. Dow Jones 3381%. SSE Composite, that is China, 362%, and London Stock Exchange 60%. No one is even near to our performance. Of course, there may be some indices which started not from the 1986, from where this chart has been prepared. But as you can see, the yellow line, that is the FTSE index. This has the same start, and Some indices are overlapping, so it is not clear. But nevertheless, our performance is way better. So be it the 5 years, be it for the maximum since inception, we have outperformed. India has outperformed, and I do not have any doubt that in the long run, in the foreseeable future, India will continue to outperform. Now, this is a very well-known face, well-known name, stalwart investor, Mr. Peter Lynch. What he has to say, and he has a world record. He has a high record of being a fund manager, and where for 13 years in a row, that fund has delivered compound returns of about 29%. That is a great record. What he has to say is nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you are investing. Everything boils down to the companies where you are invested, the companies you own. That is the ultimate thing because in the long run, share price is a slave of the earnings of the company. That is the ultimate truth. Come what may. There's a feedback from Mr. Meet from Mumbai, and it's long, but I would love to read it out because he has been our subscriber from a long time, maybe about 6, 7 years, I think. My journey into stock market started in 95, 96. Cut to 2005, I attended a CNBC event in Ahmedabad and decided to again invest in energy theme and bought a small quantity of GAIL. Also wanted to build a structured portfolio someday and started investing in HDFC mutual fund. Cut to 2008, after the global capital market meltdown, though the valuation declined, but capital was preserved. That is the ultimate thing. Capital should not go. Capital should be preserved. In the bounce back after 2009, again invested about a lakh capital into shares suggested by broker and lost all of the capital. Until 2018, I remained total mute in capital markets. In October 2018, again wanted to participate in the stock market and was searching a good analyst. With God's grace, I found Sri A.K. Asnani's post on FB on a senior finance leader of a listed entity. Then I bought the book Way to Billionaire by Asnani. Decided to go with smart VRC recommendations. Here on my journey of invest in what you know has begun for me in capital market. Thank you, sir, for sharing your wisdom. So this is the feedback, and he has attended my seminars and workshops also in Mumbai. So with this, we are coming to the end of this presentation. It will be followed by question and answer session. During the question and answer session, you can type your questions in the chat box with your name, or you can raise your hand using the reaction feature. Yes, Ambrosaji, kindly unmute yourself.
Hi, sir.
Yes, sir.
A simple question which I have understood from my mentor, who is also in this call, and you as well,
Yeah.
that always keep a balance which you can invest at a right opportunity. So,
Always
is this
keep
a
it.
right opportunity? Always keep some fund for the right opportunity.
Okay.
So, is this a right opportunity to invest, or should we
Yes.
invest in 2 or 3 terms like you advised me last time?
Mhm. So, as I said, every individual has its own methods and strategies. So, as per um, my investment principle, rather, I can say, I never asked for to keep a separate fund, to keep liquid fund to invest when the market are down, because as I believe we cannot predict the market. So, in that case, if you have the funds, then it is well and good. As far as the is it the right time to invest? I would say that because the market is itself down by 12 to 13%, and there are
Mhm.
good quality stocks in the mid cap and small cap space which have fallen by about 25% also, 20 to 25%. So that those stocks give a good opportunity to buy. And whatever the free funds you have to invest, you can invest about 50% of that and keep 50% with you. Because as I said, it is not possible to predict the market. Maybe in times to come, if you get more opportunity, you can invest more.
Perfect. Thanks a lot, sir.
Thank you. Thank you. So in chat box, it is known that when equity do not perform, gold do well. Why not invest in gold? Maybe my strategy is to have a balanced portfolio, not only in terms of stocks, but also in terms of the assets. If you have, because of the increase in the share prices, if your proportion has got disbalanced, if your investment in gold of the total investment in gold is less than 15%, then definitely you can top up and bring it to 15 to 17%. How far can we rely on AI in the field of predicting stock market? See, just a couple of days back, market, the BSE sensitive index increased by about 800 points, and after an hour, it fell by about 900 points. Now, I think this is something which no AI or no algorithm can find out, because many a times it is news based, and news cannot be predicted by AI. Should we buy stocks near stop loss resistance? No, if it is required, we will definitely give you a recommendation to buy. But just simply because it is near to stop loss, don't buy. आप स्टील इंडस्ट्री को ग्रोथ के लिए कैसे देखते हैं? Of course, there is a good demand for steel in our country because of the growth in GDP, of course. But at the same time, there is a lot of dumping from the China and other countries. So that way, steel companies are not doing good. And recently, JSW Steel has declared the results, but results are not at all encouraging. So for the time being, I would prefer to remain away from steel. In the present scenario, whether you prefer large cap, mid cap, or small cap companies. So it is not the large cap, mid cap, or small cap. It is the story. It is the valuation that matter. If any large cap is also good, if it looks good from a story point of view, from the valuation point of view, go for large cap. Nothing like that. Ultimately, as I said, it is the valuation that counts. In this falling market, what should I protect? What should I do to protect my portfolio? I put more money in smart multi-bagger stocks which already have fallen. As I said, if it is required, then we will definitely send you the broadcast message to all the subscribers for that. SBP and smart multi-bagger returns is generally compared with Sensex, but SBP stocks are mostly small cap or mid cap stocks. Is it not right to compare SBP with an index like Nifty Mid Cap 100 rather than Sensex? Yes, you are right. But at the same time, we started in 2001. SBP was started in 2001. At that time, there were only very limited indices, and one of them was the Sensex, and also there is one more with the name of, I think, All Cap, BSC All Cap. As I said during the presentation, we are going to detach Smart SBP from Smart Gains, and with that, we will also change the benchmark index to All Cap index. Your advice is very sharp this time for investors who started post-COVID. Someone of your stature can only make an opinion like this in public. More power to you. Okay. Thank you. Because stock market is not the volatility, rather I should say, is not for everyone. It is really, really very painful. Uh, when I started in 88, 89, and as I said, after 3, 4 years in 91, 92, I lost principal as well as the gains, whatever I have made. And that was a very painful because it is our hard-earned money. But then you need to introspect yourself where you went wrong. That is the way to keep on improving. And it is a slow process, it is a long process. And once you overcome a couple of crashes, then there is no looking back. Then you know very well ऐसा कभी हुआ नहीं कि मार्केट गिरा और उठा. I want to put 50% of my cash now. Do you recommend buying index or selective stocks? That is up to you. That depends on your risk profile. If you feel safe with the index, you can go with that. Of course, as we all know, if we invest in individual stocks, then it is a game of high volatility, and also you must have the knowledge about the valuation and the confidence and strong conviction. But if you see Hang Seng, it is not moved since last 7 8 years. So Hang Seng is, we all know that the China's growth has come down and from last 4 5 years, and that is the reason why the Chinese market is not performing. Moreover, in China, they have a very robust real estate market, so people invest in real estate rather than in stock market. I need to speak to you on call when it is a good time. Okay? You can call anytime, maybe from 11 a.m. to 1 p.m. and in the evening after 5 p.m. I am your subscriber but have many old stocks before subscribe your service. Are you providing portfolio restructure or management advice? No, sir. Being a research analyst, we can recommend any stocks, but it has to be along with the research report. And you can appreciate that we cannot prepare a research report for each of the stocks you're holding. We learned from you, sir, that we should remain neutral in all market conditions. Up and down is nature of market. Patience always pay. Yes, of course, patience will pay. At the same time, you must have the right stocks. Then only patience will pay. When we are investing for long term, timeline is like 2 to 5 years. So when times like present come, dip of -10% from history, how long does market takes to recover? See, these all things are unpredictable. How long it will take, no one knows. If you go to the history, you can find out some data, but there is no guarantee that how fast it will overcome, because 10% is not a big fall compared to what we have seen 40, 50%, 60% fall. So if there is a 60% fall, definitely within a year or two, you will see that 60 to 70% of the fall is recovered immediately. If I have not invested in SPV portfolio, if I have to invest 20 lakh, can I start putting 1 lakh in each? Yes, you can do that. Melvin G, yes, you can do. Is it advisable to realign portfolio at this point when some of the stocks from portfolio are in losses? Okay, I'm not taking the name. See, as I said, it is not the price which you pay that matters. It is the future which matters. It matters whether you purchased at 10 rupees or 15 rupees and the current price is 5 rupees. If you expect that the price will go to 20 rupees, then good bet even now. Of course, you purchased at higher price. So it is always the future. It is the potential for the share price to move from here to where. That decides whether you should hold or not. It should not be that just because I am in loss, so should I sell? Should I compensate with the short-term profit? Don't go into that. That is a very, I should say, a negative type of approach as far as the total returns are concerned. Always look for the future prospect. So this is all. If anyone has any question, you can raise your hand through the reaction box or write in the chat box. So with this, we have come to the end. Thank you very much. And I see a good presence considering the poor sentiments in the market. Still, a lot of people have attended this webinar and have a josh and keep smiling. If you can smile, अगर आप अंदर से खुश हैं, अगर आप अंदर से हैप्पी हैं इस मार्केट में, then you are happy. That is the ultimate thing. Yeah. मैं क्या कहूँ, मार्केट सिर्फ 12% नीचे है, तो ये तो कुछ भी नहीं है. Good luck and enjoy.
Okay, thank you.
Thank you. Thank you. Thank you, Bimal ji. Thank you.
Namaste. Namaste.
Thank you. Thank you. Thank you.
Thank you, Rajil.
वो बोला भी 300 लूंगा तो फिर
Thank you so much, sir. Actually, it was very much required at this moment.
Thank you. Thank you, Fateh ji. Thank you.
Take good care, sir. And once I'll back to India, sir, definitely I'll come and meet you, sir.
Yeah. Sure.
Sir. Thank you. Good day, sir.
Thank you. Thank you. Have a good day. Bye-bye.